the European institutions, European players in the market. So and they have their own regulations, they have their equivalence process, etc. So the point is, which is more important, home regulator, foreign regulator? There's a multiplicity of regulators, and there are multiplicity of global standards. Now, European standards are different from the international standards which are given by CPSS, ISCO. So those sorts of issues, we are dealing with that. And then unintended consequences of global reforms, the concerns, the needs of advanced economies are different from emerging market economies. For example, higher capital requirement. Will it affect our needs for funds for infrastructure financing, SME financing, huge credit demand in our country? This is my last slide. Sorry, I'm taking slightly more. Very quickly, we keep saying that our economy is doing well and our market should be fine, etc. But still, there are global shocks in terms of currency devaluations, volatility, Fed rate hike, anything in the market which affects markets all over the world. So we have to manage global shocks, market turmoil, volatility, and newer challenges due to technological advancements like high frequency trading, algo trading, etc. Unauthorized schemes, there are plenty in our country of our size, low capital raising, and we need to, on the development side, we need to ensure wider penetration of our mutual funds, expanding financial literacy, and also, the usual expectation from the regulator to be alert all the time and strengthen their surveillance and enforcement capabilities. Thanks for your patience. Sorry, I took more time.
Thank you, Mr. Amarjit Singh. Dr. Kalpana Kochhar has to leave in 5 to 7 minutes. I'm throwing the session open for questions. So would you kindly, those of you who have questions for her, sort of raise your hands, identify yourself, and ask your question quickly, because she has to leave very soon. And then the other panelists, I think, don't have that same requirement to leave soon. Please, go ahead.
Manproud from Delhi University. I think that my point is related to Dr. Kochhar only. I think she has touched upon only the one word, financial deepening, and she's taking credit GDP ratio. So I'm not asking a question and there is no comment on her lecture, but I want to add one thing more to her lecture, that I think she should think about this broad money GDP ratio, which has become the very relevant idea about the financial deepening. In India, I think from 40% in 1980, we have increased now 80%. I think from the during 20 years, Indian financial system has been providing positive real deposit rates to the depositors, increasing nominal rate, deposit rate, and by keeping inflation low. So, and in this way, our financial deepening has become one of the most important, indicator in India. And India has achieved a high level of, financial development depth.
Thank you.
And and in this way, this ratio has also put the private, private corporate saving has gone up to 9%. And in this way, I think, this has become the most important idea to the relationship between the financial deepening and growth. So please think about that. Thank you very much.
Thank you. The gentleman here, please.
Thank you, Dieter from Berlin. First of all, thank you to all the panelists for excellent presentations. I think this was a very stimulating session. Mr. Singh mentioned light touch regulation. The last time I heard that was by Gordon Brown in 2005 or so, and I don't think he has been using it ever since. So light touch regulation is, of course, might be something rather risky. I would like to point out to a difference between crisis management in the European Union and crisis management in the UK and in the US. Americans are much better, probably not in repairing bridges over the Mississippi, but much better in closing banks. The Federal Deposit and Insurance Corporation has closed about 500 banks since 2008. And in Europe, we have been declaring, continental Europe that is, we have been declaring banks as so systemically relevant that nobody had heard of before. So there is a problem in understanding how capitalism works, if I may put it into a more fundamental term. We can't rescue everything, and if you rescue everything, you create moral hazard, and this is a key to solving financial crisis. What I think we observe, Mr. Singh, you mentioned that we see regulatory divergence between countries. And I think this is a process that has been growing since 2013. The US is regulating big foreign banks in the US. They don't accept home country regulation anymore. They implement host country regulation. Now this is a big and I think underestimated departure from the paradigm of global finance. If the US starts it, everybody will follow, and some other smaller countries have been implementing their own tailor-made regulation. For instance, Switzerland. They, Mr. Krishnan mentioned that 18% we do as capital requirement for banks. The Swiss authorities are asking 19% from their two large banks, Credit Suisse and UBS. That's quite something. A more fundamental point, and we are more policy-oriented people in this room, I think, but there is a discussion out there which I find fascinating, and the IMF has been pushing it, surprisingly, may I say so. The IMF has put out a working paper on a radical increase of capital requirement to 100%. 100% was a proposal made by Irving Fisher in 1936. It would basically end the ability of banks to create money. It would end fractional reserve banking. It is, of course, totally heretical, but I think it is, in a quiet moment, interesting to consider that there are much more radical proposals out there than the ones we are currently discussing. And less radical is, of course, the head of the German Bundesbank, Mr. Weidmann, who has been suggesting that we should end the legacy of Basel I, the legacy of Basel I being that banks don't have to put capital aside when they lend to OECD countries such as Greece. This has been a mistake, and this should be corrected, and this has provided us with the wrong incentives. This is a mistake to assume that lending to governments is risk-free, and therefore you don't have to put any capital aside. Just a brief comment. Maybe the question would be, do we have any chance to get rid of Basel I's capital requirement with regard to government lending? Thank you.
She's already answered the question by saying no, because she didn't put on her mic. Some may not have heard it there. Back. Any other questions, please? Because we have limited time, because lunch has to start. So if you would reserve your comments for discussion during the lunch hour and be very specific and ask questions.
I'm Chandra Tukorala from Australian National University. Dr. Kocha, have you thought about the implications of economic slowdown in China for the figures you presented? I know that the ADB figures were prepared well before the share market collapse and adjustment growth rate. This China slowdown would have both direct impact on capital supply. Indirectly, China's export competitiveness is going to be greater following the crisis, and that would also have implications for other countries in the region. Thank you.
So again, the short answer is I don't think we've really, anybody's gone back and looked at the funding requirement, estimates of funding requirements in light of the collapse of not just the Chinese. I don't know if the Chinese stock market collapse has necessarily by itself, but well, the China economic slowdown has, is again double-edged. In some ways, you could argue that the demand for resources will be lower because of that, and therefore the prices. So look, I think there are many ramifications of China's slowdown, of the currency movement. Yesterday we talked about, things like competitive devaluations. The Chinese currency moved very little, to be honest. So I think there's a little bit of much ado about nothing, but nevertheless, there's a lot of ramifications from that, and which I think in the fullness of time, which is actually not that long, we have to examine.
Thank you. Any other questions? I can see a hand here, please.
Yeah, I'm Ashima Goyal from IGIDR. My question is to Krishnan and to Amarjeet, since they talked about the FSDC. You know, a concern to Amarjeet how it is working, and this issue of if the political class is put in charge of financial stability and systemic risk. In India, we have this history of financial repression. And politicians have a short-term viewpoint. 5 years, they're going to go in for elections. They want to focus on growth, take risks if necessary, maybe invite too much capital, allow too much capital account convertibility, and this builds risks. So, and then there is also an issue of delay. If you have to coordinate so many people, are you not reacting quickly enough to information you get as a regulator? Do you have to wait to coordinate with other regulators? These sort of issues. And the other question was related to G20 and this, both the requirements of advanced economies and emerging markets being slightly different. But also this whole focus of Basel III on capital adequacy and capital requirements. When in bank-focused countries like India, you have to depend on banks for financing development and largely. Then what about alternatives like leverage caps? Or India had a very good experience, say, in regulating the estate market with provisioning norms. And these are really far-seeing because it was macro-prudential tools being applied before they were talked about in the rest of the world. So are we able to push our success with these instruments and sort of suggest alternatives to this huge capital requirements in the G20 and Basel III? Thank you.
I'll let Amarjeet handle how FSDC is working now. I'm not part of it. But a very quick response to your other point. I don't necessarily share the view that you've sort of expressed vis-a-vis politicians. I'm sort of on a general point here. A lot of the discussions when you are dealing with stability type issues in a crisis clearly involves using taxpayers' money. And that's not a decision we can constitutionally, legislatively leave to regulators. Regulators can deal with a whole bunch of issues, but certainly not committing taxpayers' money, number one. Number two, whatever I saw of 2008, all the answers came from the political class. The regulatory structure, I was secretary of this committee that we are talking about, and one can speak about it now. It's 7 years later. The regulators were unwilling to do anything about exactly the crisis that you are talking about today. We nearly had a collapse of at least 2 mutual funds, 3 or 4 large NBFCs, but for the announcement that the central bank would backstop liabilities of these institutions through banks, something which the US had done at least 3 nights earlier. The Indian regulators refused. It's the Indian politicians who decided at midnight to make the announcement overruling the regulators. We, I think, prevented a huge crisis essentially because the political class stepped in. So I don't think it's very correct to say that the political class generally, you know, the populist point, the financial repression point, all of that is true. But I think in a crisis context, my sense is Indian politics has actually responded very well. And we practically owe Indian financial sector reform to the response of the Indian politicians to crises like Harshad Mehta, Ketan Parekh. Every reform that we've seen in the Indian financial sector was the result of politicians seizing these crises with 2 hands and moving forward. So I share a slightly different view on politics. Over to Amarjeet.
Thank you, sir. See, let me, perhaps add on to what Dr. Krishnan has already said. One is, see, this FSDC works at the FM level. I mean, FSDC is chaired by FM, but the FSDC subcommittee is chaired by RBI governor, which meets more regularly, which has more meaty agenda, which actually discusses, issues of regulatory arbitrage, regulatory gaps on a continuous basis, and there have been results. I mean, I can share that with you maybe separately over lunch. So the structure is very much there, and in terms of coordination, etc., those issues, especially at the subgroup levels, they remain, and that is always, but the structure is well thought of. That's my understanding, and I believe it is working reasonably well, in the sense that having been part of some of those things. So, but there are always issues that we can always do a better job. So no denying that. And let me also say, in terms of some of those issues, how they will be addressed going forward, in terms of the FSLRC recommendations, the whole regulatory architecture is being reworked. In fact, as a part of that, SEBI is taking over FMC very soon, later this month. From 28th September, FMC, the Forward Markets Commission, which is responsible for commodity derivative regulation, is getting merged into SEBI. So the idea is, going forward, there is a need for integration of regulatory agencies other than the banking regulator. So perhaps those coordination issues will be handled like that. Yeah, that's it.
There was one hand there. I'm afraid that will have to be the last question. We will continue discussing at lunchtime, and because I want to close the session with a few remarks. Please, go ahead. Please identify yourself.
My name is Kawaljeet Singh. I work with Madhyam. It's a policy research institute based in Delhi. My question is to Amarjeet Singh. You mentioned that now the FMC would be merged with the SEBI. My question is that at the G20 summit in 2008 and 10, the leaders gave the mandate to IOSCO to bring out new guidelines, new principles regarding the regulation of commodity derivatives market. In India, we have seen none of those principles have been implemented so far by the FMC. There were a lot of problems with the FMC. I don't want to go into that. Now my question is, once the SEBI takes over the FMC functions, will it be willing to implement those principles which are very sound as far as the regulation and supervision of commodity derivative markets are concerned?
See, I can speak for SEBI as of now, and this is, of course, this is just around the corner. This is going to happen. Let me give you, our track record, SEBI's track record in terms of compliance with the global standards, and we've been compliant or broadly compliant as far as IOSCO principles for securities markets are concerned. And our attempt would definitely be, once we take over FMC, we would definitely like to see what are the global benchmarks and how we can, bridge the gaps. Thank you.
Thank you for those clarifications. Before I thank the panel, just want to highlight one or two things which may not have got fully explained because of shortage of time. That is the aspect of development of markets. In the case of the G7 countries and other developed countries, other OECD countries, their financial markets are relatively well developed. And by financial markets, I refer not just to banking and capital, but also insurance and pensions. As we all know, in India, the last two named, insurance and pensions, are not as well developed. For instance, in the insurance space, and I'll stop there, we have a behemoth which is not listed called LIC, and I will not get into the extent of LIC's involvement in the equity market. All you have to do is to look up the numbers on the NSE's website or the website of the BSE. But development of our markets, which is something which other regulators perhaps don't have to do so much because their markets are already well developed. So whether it is consumer protection, as was mentioned by Dr. Ila Patnaik, or the several other aspects of developing a market, making people more familiar with financial products. My recollection from the last Reserve Bank of India annual report was that the preferred instrument for those who have some savings, adequate savings to actually invest in financial instruments, the preferred instrument by an overwhelming proportion is fixed deposits or postal savings. So obviously the other products have not developed that much in India. So whether it is because of the financial crisis of 2008, which was global, or some other crisis that was mentioned by Dr. Krishnan about Harshad Mehta, or they have seen that Hindi movie of yesteryear called Satta Bazaar, where this man is kind of tearing his hair out because all his investments have now basically become worthless pieces of paper. But there is also this other aspect of information to people, which the regulators are, fortunately or unfortunately, have to carry out, because they are always hard pressed, given the fact that the financial market firms are always trying to be one step ahead of the regulator, because they pay better salaries. Let's just face it, they are much better paid in financial sector firms, and therefore they are constantly looking to tread that narrow path between what is legal and illegal. So it becomes sometimes very difficult, and as we know in our country, legal remedies take a long, long time to resolve themselves. Now, without going further into all that, at this stage, I think we have covered such a vast territories that it'd be impossible for me to try and summarize. I think it now is best for me, because I'm standing between you and your lunch, to thank Dr. Kalpana Kochhar, even though she has left, Dr. Ila Patnaik, Dr. Krishnan, and Amarjit Singh for taking the time to come here and speak to you all. With that, I conclude the session, and I'm sure lunch is waiting for you. Thank you so much.